So the government increased their loan limits, conforming loan limits or conventional loan limits, and FHA loan limits. Talk to us about that. How did they change?
Yeah, it was a big step up. They moved conforming loan limits, those loans that are securitized by Fannie Mae or Freddie Mac, those big government-sponsored entities, all the way up to 766,550.
Conforming loan limits, Fannie Mae, Freddie Mac, what'd you say?
766,550.
766,550. And before, if you had a $750,000 loan, you were a jumbo loan. You weren't in anything where you could get the best rate and the longest fixed rates. How about FHA?
FHA is still determined by geographic region, or what they consider metropolitan statistical area.
Yep.
But it is always a percentage off of that conforming loan limit.
Okay.
So like in the Atlanta metro area, 498, 257.
Okay.
Is what it came into, which is a step up as well. So we've had some significant improvements there, which just provides more liquidity to the market. We're able to finance more people and at a lower cost.
Now that we've gotten into the subject of interest rates, what's the outlook for interest rates? Everybody wants you to look into your crystal ball and tell them exactly what's going to happen with rates. I know you can't do that next year, but give us some thoughts on mortgage rates in 2024.
They're going to be better.
Yeah.
I mean, no doubt about it. The question is how much better and when. You know, we've already seen significant improvement with interest rates dropping over a full percentage point from their highs in October just in the last 6 weeks. In fact, we've seen some improvement just in the last 48 hours. It would bring it down closer to the mid sixes for most folks. So it's even, well over a full point better now. And I would not be surprised if over the next 60 to 90 days, we start seeing maybe some things with a 5 in it. So it's this improvement has been, it came a little sooner than we expected, I think, and it's been more dramatic than we expected. So that's a real positive sign.
How does if you don't mind me asking, how does the Federal Reserve cutting rates, how does it actually affect mortgage rates?
Well, the easiest way to think about it is that when the Federal Reserve is cutting rates, that's where banks borrow money from. So if a bank is able to borrow money at a less expensive rate, it can then turn around and loan that money back out at a lower interest rate. So it filters through the entire economy, all the way from mortgages, credit cards, auto loans, etc. Everybody's going to pay a little bit less.
Exactly. But it doesn't necessarily directly affect mortgage rates, because the Fed could drop rates and mortgage rates could go up based on some uncertainty or certainty around the world. So they can go in different directions. But in this case, Federal Reserve increases have tended to influence mortgage rates, kind of tit for tat, if you will. And my guess is as they come down, the same thing might happen. You agree with that?
At least in the short term. There will be a kind of a law of diminishing returns, where the Fed is still cutting rates to stimulate economic growth, and mortgages will get to a point where the demand for those mortgage-backed securities might stall out, and that'll kind of put a floor on how low rates might be able to go at some point.
Like, I don't ever expect to see rates down as low as we saw them for a while, 3%, 3.25%. I just don't expect to see that. But the reality is if you get a market where the average mortgage rate is, in the fives or high fours or low sixes, I mean, historically, that is a good rate.